Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, June 6th. Another pretty solid week for the equity markets. It's almost as if it's a normal year. We're heading into the June month, almost halfway through the year. S&P up 2 and change, NASDAQ up 4 and change. The only index not involved are small caps, call it the Russell 2000. But even there, you've seen a better tone, a better bid. It's almost as if nothing happened in Q1, yet we know that S&P had a 20% drawdown, peak to trough. NASDAQ more than that. Headlines have been rampant, nonstop. Politics have been involved. Today I wanted to share a chart to go over longer-term investing and shorter-term investing. I think it's a fascinating chart. It was put out by NASDAQ Dorsey Wright, who many of you know we lean on for some of our relative strength and trend work. But Christopher, leave this up for a few minutes. Christopher is our crackerjack videographer. So anyway, what are we looking at here? S&P 500 holding period returns 1950 through 2025. That's 75 years of rolling monthly returns. Think about how thick this data set is. This isn't picking and choosing to make an opinion look good. We see that on TV every day. This is real data. And what I wanted to discuss today was some statistics, because markets are all about math. Markets are about statistics as much as they are about companies. So if you had invested money in the S&P 500 from 1950 through 2025 in any single day, again, think about how thick this data is. By the way, S&P 500 index didn't come around until 1957. So included in this data is the predecessor index, which was put out by Standard Statistics. That was 90 stocks. So I'll give you a little information there. Anyway, great data here. Top line, percent positive. 1 month later, 64%. 1 year later, 79%. That's a shocking number. That if you had invested capital in any one day over the last 75 years, 79% of the time you would have had a positive return 12 months out. Look at those figures and how stilted they get in your favor as time starts to work for you. 97% of the time positive after 10 years. And after 20 years, we hear this often. There are no periods where you've had a negative return. Very solid average returns in the second row. Median returns, very solid. Max return, well, we know the equity markets have been a compounding machine for years. That's not a surprise. Minimum return. I want to talk about this for a little bit. In any 1 month, the worst return was negative 32%. In any 1 year, negative 47%. Let's go out to 10 years. There was a period there that you had negative 38% returns over a 10-year period. People really can't fathom that. And why I mention it is, it seems easy when we look at these holding period returns. Just put your money in and let it compound. And by the way, that's probably the right move for a portion of everybody's investable assets. But it's that bottom line that sticks in our minds. Those drawdowns influence our behavior. And I saw that in Q1. I had call after call. I thought more calls than were warranted, to tell you the truth. And I do believe it was the noise. It was the political noise. It was the headlines. It was the TV banter that created more fear than was necessary. But that said, drawdowns are a real thing. Let's take a look at that bottom chart. S&P 500 odds of a 20% drawdown by those same holding periods, 75 years of monthly returns. It's not always smooth sailing, is it? Over 1 year, it's a coin flip. 51% of the time, you're going to have a 20% drawdown. Over 5 years, 69% of the time, the odds are you're going to have that kind of drawdown. Look at how 20 years, look at how 10, 94% of the time. You can't be invested in equities without surviving drawdowns. It's not always smooth sailing. This is a tax. This is a VIG in gambling terms for the incredible compounding that you're able to earn from equities. So what we're looking at here is the good and the bad, the positive and the negative. The negative being what you have to put up with to earn that massive compounding. And in terms of what we do on an advice side at Cumberland, we work in that 3, 5, 10, 20-year timeline to try to see how much we have to dampen the possibility of those drawdowns. So when a client may say, why aren't we 100% invested in an up day or an up month? We're using statistics based on the age, based on, are you in an accumulation phase? Are you in a distribution phase? We use much of what you're looked at on that screen to identify proper allocation. And we do that day in, day out, month in, month out. So the key point here is longer term, markets work out. But shorter term, we always have to be aware of drawdowns. We can either use them to our advantage or get panicked by those drawdowns. Understand going into the year, into your portfolio, what your risk set is. So, quiet year, you could say. S&P up 2, NASDAQ up 4, yet we've been on both sides of 15, 20% returns this year. We'll keep an eye on the returns. We'll keep an eye on allocation. In terms of what we saw this week, you'll have John Musso discussing bonds, 4.5% on the 10-year. I think you probably have gotten almost bored with what our thought is, and that is 4 to 475 or so may be a trading range. And if it is, I think other asset classes can prosper. So heading into the back half of the year, I know there'll be plenty of action, plenty of volatility. Stick with us. We'll have some fun. Moose is up next.
Hi, it's John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday afternoon on June 6th. This is the bond report. Yields this down week, higher on treasuries. 10-year started the week at a 440, ending the week at a 450. 10-year muni basically unchanged at a 333. So two different worlds here. There's no question the Treasury market is reacting to what we saw in the jobs number today, higher than expected. So the jobs number was expected to be 126, came in at 139. That's 13,000 higher. However, last month was revised down, but the market didn't care about that. Last month was revised down 30,000. But the market was leaning probably the wrong way, and that's because yesterday the initial jobless claims were higher than expected. Continuing claims on jobless claims continue to be high and have not come down, which meant people are going on to basically the jobless rolls, but not coming off. It will be very important next week to look at the CPI numbers, which are expected to be 0.2 on headline inflation and 0.3 on core inflation for the month of May. And there's no question in our minds that the Fed is really not budging until they get some satisfaction that inflation is not getting pushed up significantly higher from the tariffs. And that will be what we're watching certainly next week. When you think about the fact that basically headline inflation has, on a year-over-year basis, is down significantly from where you were even at the time of the election, which was running at about a 2.6, it's down to about a 2.3 on headline inflation. When bond yields are higher, particularly in the longer end, longer yields are decently higher than they were back before the election. It tells you that there's some attractiveness in bonds out here, absolutely, for sure, and particularly on the muni side, where you can get basically mid to high fours on a lot of paper, and we're using that to construct part of our portfolios, because we certainly think that those coupon levels that you're seeing will carry the day. And even if you have a little bumpiness in the bond market, coupon levels are high enough now that they can cushion that effect. We hope everybody has a great week. We will talk to you next week. Thanks.
Thanks so much, Moose. And by the way, I encourage you to share those charts with family members that are investors, friends that are investors. There's a lot of really great data to mentally stew on. See you next Friday.